All right. Welcome in, everyone. Welcome to today's Financial Friday with Sainies and Equitable. Today's topic is how a financial planning analysis works, and we are very excited to offer these sessions in cooperation with our corporate partner, Equitable Advisors. And joining us today from Equitable is Kelly DeMay and Luke Yanklowski. Just a reminder, everyone, the session is being recorded, and we will save questions until the end of the presentation, but feel free to add questions to the chat at any time. And just a reminder as well, our Q&A time is best used for general questions, but please know that the Equitable team is available at any time to answer your personal questions. You will find contact information for your regional reps at sanies.org. And now I will turn it over to you, Kelly. Luke.
Thanks, PH. Welcome, everyone. So you get the real deal. As a part of being a Sanies member, part of your benefits is that you get a complimentary financial profile. Part of your member benefits is something that it includes. So we're going to go through today what that means and what that is, what to expect as part of that process. This is our disclosure. Just indicates that we are not tax professionals. So our agenda today. So Equitable and Sanies have been partnered for about 10 years, and we're going to get into the details of what a financial plan is and what a financial planning analysis means, how the process works, why the importance of a review is in place, and how we begin. Luke and I actually are the two that do the financial planning analysis, so you're hearing it from the horse's mouth exactly how it works. So this is the real live what to expect. We are the two who do it. Part of your Sanies member benefits is that you have exposure to the Dear Kelly monthly write-in column. You see that on Sundays as part of your Sanies member email. There's these Financial Friday webinars that you have exposure to, and they're on the Sanies website recorded. You also have exposure for seminars and webinars for your districts in your region. Certainly, if you want to do something more specified for your unit, please reach out to us or the Sanies. We'd be happy to facilitate that. If you need any guidance or insight on a specific or sensitive matter, you can also reach out to us or the Sanies members at equitable.com email address. And then as always, and what we're going to go through more specifically today is the complementary financial profile. Everybody's financial situation is unique and specific and different. One of the biggest problems, challenges that we run into is that school administrators are so focused on taking care of others. They often, don't have the time and the resources and the energy sometimes to put the focus and care into their own situation. So we want to go into the specifics of how you care for your own household first. So what is a financial planning analysis? So what we do with this is we evaluate your specific information. There are no two circumstances that are the same. First, we evaluate your specific goals and objectives. So someone's goals for retirement could be sipping lemonade on their back porch, or it could be traveling the world. Those two people are going to have to save two completely different amounts in planning for their retirement future. The most common thing that Luke and I hear is people say, I want to be comfortable in retirement. But so for some people, that might be living off of $12,000 a month. For others, that might be living off of $5,000 a month. There's a big discrepancy there. So what that means, we have to get a plan for how to accommodate that. In that, we're going to evaluate what you currently have. But really, at the end of the day, driving the bus is cash flow. Where is money going to come from? What is it going to look like to earn your pension every month? Social Security. How are your retirement accounts going to play in? And how are taxes going to account for all of that? How well funded are you? And then what are changes and adjustments? And then the most important part of this process is the review of all this. The one thing I can guarantee every single person, their situation is going to change. It's going to change for the better. They're going to pay off debt. They're going to have increased cash flow. They're going to have their kids off their payroll. The bank of mom and dad eventually will end. It's going to change for the worse. Unforeseen expenses come up. Heaven forbid something happens to someone. in any event, somebody's going to have to meet to revisit and evaluate and change and adjust their plan. So this is a malleable, dynamic document that's going to have to adjust over time. So now we're going to get into what specifically this means. So Luke, go ahead.
Thanks, Kelly. What I'm going to talk about first is a little bit about what the actual process looks like, and then I'll go into what does the actual financial plan and analysis look like. It's really a 3 to 4 step process depending on the person or individuals or couple or whatever it might be. So the first meeting is really just where we get to know folks, ask some questions, learn, what are their major priorities, what brought them to the meeting, what are they looking to really get out of it. It's more of just a Q&A, and then we talk about what we're going to go through, what they can expect throughout the process. In the second meeting, this is really where we gather data, we gather the inputs, because like most things in life, a financial plan, the outputs are only as good as the inputs that you take in. So we call it soft data and hard data. Soft data is the goal-oriented data that somebody has. Things like, when do they want to retire? What are their biggest financial concerns, priorities? Do they want to pay for their kids' college, leave an inheritance, whatever it might be. Hard data is things like income, assets, liabilities, expenses. Both are equally as important when we build the actual financial analysis, because if you think about any type of financial planning, whether it's retirement planning, college planning, doesn't really matter. We have to think about, okay, what do we want and how we're going to fund those things. So that's where the soft data and hard data comes in. In that third meeting, this is where we actually go through what we call an asset map. So in one of the slides I have coming up, I'll go through what an asset map actually is. We do a cash flow analysis, and then we actually run through financial scenarios and projections and say, this is the trajectory that you are currently on. From there, we have a discussion around all the information that we went through. So we debrief it. People kind of come to the conclusions in their mind of what we're talking about and then go through recommendations. Depending on just what somebody's goals are, how complex their situation is, that strategy phase of thing can occur in one meeting. Sometimes it takes two, or honestly, commonly it takes 2 meetings. So what we do is we call it the macro and the micro. There are macro, very big picture recommendations, and there are micro things they can do today differently. So often we will go into a second meeting and talk about those things in further depth in that second meeting and talk about what would next steps look like from there. So what that actually looks like. Every plan we build is specific to each and every individual or household. As I said, the first thing that we start with, the first thing everyone's going to get is what we call an asset map. An asset map is an aggregation of all of the hard data that we collect in that profile. So anything in the blue is going to be an income. So current income, and then the grayed out blues are future incomes. So helping people to look at what their different payout options for their pension is going to be, what options they should take. Along with that, Social Security, should they collect right at 62? Should they wait a little bit? Should they defer all the way to the 70? What are the pros and cons of collecting early or deferring? Anything in the pinkish red is going to be a retirement account. So this would be things like 403Bs, IRAs, 401Ks, 457s, looking at where the account's held, what type of account it is, how much they're contributing, the balance, and of course the investments in there. Are they more conservative, moderate, and aggressive? And is that where they should be? Anything in the green is a non-retirement asset. They could be normal checking savings. Do people just have enough in an emergency reserve if something comes up? Can we pay for a sudden $1,000, $2,000, $3,000 expense? It could be a 529 plan if we have some goals around saving for college. It could be non-retirement investment accounts or health savings accounts. Anything in orange is going to be a liability. It's going to be mortgages, car loans, personal loans, credit cards, student loans. do we have the most effective strategy to actually pay down our debts? Are we paying the lowest balances first, the highest interest rates? Can we do public service loan forgiveness or teacher loan forgiveness? And just looking at what debts are we going to not have or pay off prior to retirement? Which ones are we going to carry through into retirement? Anything in the gray would be a property, things like home. It could be a second home, it could be a business, it could be just land they owned. And then anything up top in blue would be insurances, things like life, disability, long-term care, what they get through the district, what they get through the state, what they get through Sainies, and maybe what they have privately. So the asset map is really just, as I said, an aggregation of all the hard data. It really only tells us half the picture, but it's a nice way to see everything in one spot and get organized around your finances. Because whether you're headed into retirement or you're 20 years from retirement, it's very important that we're organized around our finances. So from there, what we do is we run what's called a target map. And a target map is where we actually look at a base scenario and recommendations. This is where we actually look at what somebody wants relative to what they have. So we can see for the Smith household, as we talked about, we help people calculate their cash flow every single day. People tell Kelly and I, we want to live comfortably in retirement. But what does comfortably actually mean? It could mean $3,000 to me, and to PH, it could be $10,000. So we take people through exercises to figure out what does comfortably mean to them. And then do they have goals in retirement that are going to be an expense over and above and beyond what they're spending right now? A big one is travel. If I have a goal to travel 5 times a year in retirement, but I'm not traveling right now, that's an additional expense that I need to account for in retirement. And then what are some of the things they're maybe not accounting for, but are going to be a very real expense? Commonly, these would be things like medical expenses and long-term care expenses. Medical expenses are the number one unplanned for expense facing retirees today. The average American household will spend over $300,000 on retiree medical expenses. So we help to take folks through and make sure A, they're accounting for that, but B, what is it actually going to look like for them? Medical expenses work very different from a district to district, union to union, in person to person. People are hired at different times. People have different unions, so they have different benefits. We find a lot of folks, they talk to the retiree that retired 10 years before them of what their medical benefits were. They may be in the same union, but hired 10 years later, you'd have totally different medical benefits. So we'll look through folks' contracts and see what do your medical benefits look like? What can you expect to actually pay in retirement? We then put that against what somebody has. So things like Social Security, pensions, and retirement accounts. We'll take into account the cost of living on those different things and the taxes that they're actually going to pay. Obviously, when we get to retirement, many folks will say, you know, my pension's going to be $5,000. All of a sudden, they forgot to take into account that's not actually what's going to hit their bank account. There's going to be taxes taken out of those things. Then looking at retirement accounts or anything that they'll just use to fund their retirement. So it could be 403Bs, deferred comps, IRAs, 401Ks. Of course, taking in, are they Roth or they're pre-tax? Are they going to lose the taxes? But maybe someone just has a large savings, a large checking that they'll use in retirement as well. Now, the Smith household, they're pretty conservative, so we're expecting 5% return for them. So you can see when we compare what they want to what they have, they're on track to be 90% funded for retirement. Or another way to think about that, they are 90% of where they should be currently. So ask yourselves for a second, if you came up at 90% of where you should be currently, think that's good, or do you think that's bad? The answer really is it depends. You can see for the Smith household, they're $204,000 short. If they're looking to retire tomorrow, not the greatest spot, pretty hard to save $204,000 in a day. If they're retiring in 10 years, bridge $204,000 in 10 years. So as I said, the first thing that we always do is just look at, okay, if you did nothing different than you're doing today, here's where you stand. From there, this is where we build a recommendations target map and say, okay, how do we move that bar to over 100% funded? So you can't get to retirement and say, hey, Jane and Joe, you're going to run out of retirement or you're going to run out of money 90% of the way through retirement. Just eat cat food from there and you'll be good. Obviously, we can't tell people that. So, what recommendations can we make? It could be on the what they want standpoint. Maybe they're spending $7,000 a month, but they could really make $6,500 work, which $500 a month in retirement goes a very long ways. Maybe they were planning to take 3 trips a year, but they could really only afford to take 2. Maybe we do need to look at doing something different with their medical plans. Maybe they have 2 individual plans versus one plan. Maybe they're going to look at taking different Medicare options. On the what they have standpoint, it could be things like one or both parties defer Social Security. We collect a different payout option for a pension. We save more for retirement or save differently. We've put every dollar away pre-tax and we need to look at saving some Roth. It could be working part-time in retirement, or it could, maybe people deferred retirement. Could also be looking at investing differently. Maybe we're too conservative or too aggressive, whatever it may be. What we'll do though is say this is where you stand. If you do X, Y, and Z thing, it moves this bar from 90 to 105% funded. And when we're looking at those recommendations, we take into account what do people actually want to do, what's going to move the bar, and what's realistic. Some of you on this call are probably can relate to this. We talk to Saney's members every day that say, when I hit my 55 and 30 years, I am done. There are no ifs, ands, or buts about it. I am done. Okay, heard. We're not going to show that person working longer. But we may get other people that say, I'm open to working longer, but when I'm done, I don't want to work part-time. Great, heard. We won't show you working part-time. And then as far as what actually moves the bar, again, if you look here, if I have a $204,000 surplus and I'm only open to saving more, I probably can't save more $204,000 in a year. And then again, what's realistic? People will tell us, I'm going to retire and work part-time, or I'm going to retire and I'm going to consult and I'm going to make $150,000 a year, whatever it may be. And that's not impossible, but is that what we want to base our entire retirement on, is things that would be extremely challenging to accomplish? So again, we look at where somebody stands if they did nothing different than they're doing today, and what things can they implement to move that bar over 100% funded. From there, once we show someone over 100% funded, or some folks will come up over 100% funded, that's not impossible. We then want to do different stress testing. So we run what's called the Monte Carlo, and we look at just different things that could occur that could affect the retirement plan. These things can be macro, largely out of their control, economic factors, or micro, very much in their control. So what happens if taxes increase? What happens if inflation increases? What happens if we retire and the market takes a dive? What happens if we're our own worst enemy and we just spend more than we're anticipating? We take a large retirement withdrawal early on, or we find the dream home, but it's a little bit out of our budget. So we run this stress testing to figure out, okay, here are the different risks associated with your situation, and here are the things that you can do to either eliminate or reduce those risks. Obviously, there's a lot of risk out there. Unfortunately, no one escapes taxes, and taxes are a risk to everyone, but we can look at strategies to do things to at least mitigate to the risk to the extent possible. Additionally, what we'll do is we do actual investment benchmarking, and we'll just say, okay, here are your investments. This is how they're doing against various benchmarks. They're doing great. They're not doing great. Here's some things you want to consider. You should be more aggressive, more conservative, more efficient. And just looking at, are there investments working fully efficiently? So maybe you've been through some sort of holistic macro level plan, you've never looked at the micro level plan, we will do that as well. And then Kelly touched on it, but the importance of review. A financial plan is not a one-time thing. It's a living, breathing document that's going to change over time. I would love to tell you the plans we make for folks will work out perfectly from now until the time you're 90 or 95 or 100. That's just not realistic. Changes are always going to happen, some for the good, some for the bad. People get promotions, people get laid off, things happen. And we talk to people all the time that they had a very real financial strategy, but it was the strategy built for their life 10 years ago, 5 years ago, 15 years ago, and it just never evolved with them. So it's not really the most efficient path for them, or it's not really going to take them to where they want to be. So tracking over time, going through it, making sure that when things come up like those risks that we talked about, or just changes in their lives, it keeps up with their goals. We talk to a lot of people every day that say, I thought I was going to retire and be able to make it to 62. I'm just not going to be able to do that. I think I'm going to go at 55, 60, or whatever it may be. And it's like, okay, we got to make some effective adjustment and changes. And that's the importance of doing a review. So where to begin? If you would like to go through your complimentary financial profile or financial analysis, we have the Saney's member at Equitable email. You can scan this QR code. It'll send an email to that email, and Kelly will reach out to coordinate a date and time to start that process.